Hi there, my name is Robin Köpke and I work in the Global Macroeconomic Analysis Department at the IIF. One of our key concerns about the global economy in 2014 and beyond is what is going to happen when the Fed stops easing and begins to tighten monetary policy. At the December 2013 FOMC meeting, the Fed took a first step in that direction. It decided to reduce the pace of asset purchases by $10 billion to $75 billion per month starting in January. At the same time, the Fed adopted a somewhat more dovish forward guidance, both in the FOMC statement and in its projections. As you can see from the chart, the FOMC's median forecast for the policy rate at the end of 2015 was reduced from 1% to 0.75%. The trajectory of Fed exit will continue to be a key theme in 2014, with the potential to create turbulence in markets, in particular risks for emerging markets. The experience of 2013 has been a powerful illustration of the nature of these risks. During the summer of 2013, we've observed a sharp retrenchment in foreign capital flows to emerging markets. From May to September 2013, foreign investors withdrew about $73 billion worth of equity and bond flows, according to EPFR data. During that period, we've also observed a sharp decline in valuations for bonds and equities and a depreciation in exchange rates. Most people think that this EM sell-off was closely related to US monetary policy developments, and I would agree with that. However, I think it's easy to misinterpret the exact way in which the Fed impacts capital flows to emerging markets. In the following slides, I'd like to address three common misperceptions about the Fed's impact on capital flows to emerging markets. The first is that the EM sell-off in 2013 was all about Fed tapering. The second is that reductions in asset purchases will necessarily result in a retrenchment of EM capital flows. And the third is that Fed policy rate hikes will necessarily be followed by weaker EM capital flows. Let's look at that first myth. Lots of market and media commentary has focused on tapering as the trigger for the EM sell-off. In my view, tapering did play a role, but it wasn't a dominant role. Consider that tapering was actually announced in December 2012 during the press conference that Chairman Bernanke gave, in which he indicated that the committee wanted to adjust the pace of asset purchases flexibly as it was going forward, and that if the economic outlook were to improve substantially, the committee would decide to ramp down asset purchases. That is tapering. Also, consider that at that same meeting, the FOMC communicated via its minutes that it expected asset purchases to be completed in the second half of 2013. So therefore, when you look at the shift in market expectations towards a September tapering that occurred in May and June of 2013, expectations basically shifted back towards where they had been earlier in the year, which means that the shift was probably not sufficient in magnitude to warrant such a large sell-off that we actually observed. In our view, the trigger for the sell-off was related to a broader shift, a broader reassessment of Fed policy, and tapering was only a portion of that. This broader reassessment can be captured well by expectations of the future path of policy interest rate. You can look at Federal Funds futures contracts as an indication of what the market thinks policy rates will be in the future. And in this chart, you can see that there was a very large shift from early May to early September in what markets were pricing in. If you look at the expected policy rate for early 2016, you can see that there was an upward shift by over 1 percentage point over that period, which implies about 4 policy rate hikes of 25 basis points. This is a very large shift. We've tested the hypothesis that this shift in policy rate expectations was behind the EM sell-off. And we've developed a model that would capture changes in policy rate expectations. You can see the details of this model in the research note that is published below this video. But for now, let me just say that our empirical work suggests that shift in expected policy rate expectations do impact capital flows. When policy rate expectations shift towards easier policy, you get a boost, and vice versa. When you have a shift in the opposite direction, you get a drag on portfolio flows. Let me mention one additional finding of our empirical analysis, which is that bad news matters more than good news, by which I mean when you have a shift towards tighter monetary policy priced in by markets, the drag from that tends to be greater than the boost you get from a shift towards easier policy. Let me now address the second myth, which is that each tapering will necessarily result in a retrenchment of EM capital flows. According to the literature, asset purchases affect portfolio allocations in two main ways. There is a stock effect and a flow effect. The stock effect refers to the total expected stock of asset purchases. When investors adjust their expectations for the total stock of asset purchases, they shift their portfolio allocations. So in this context, when thinking about tapering, clearly the impact depends on whether markets have already priced in tapering or not. If markets already expect that a reduction in asset purchases was going to happen, then there should not be any notable impact in terms of the stock effect. The second effect is the flow effect, which refers to the ongoing flow of asset purchases. When the Fed actually purchases assets, that tends to affect financial variables directly. So when the flow of asset purchases is reduced, that degree of support declines. Now, the flow effect tends to be quite small in the short run, which is suggested by, for example, the end of QE2. Consider that the second episode of quantitative easing ended very abruptly from 1 week to the next at the end of June 2011. The end date was fully known by markets, so the stock effect presumably was near zero. The flow effect was anticipated by many to be quite significant. Many observers thought that there would be a spike up in treasury yields because there would not be sufficient demand for treasuries. Actually, that did not happen. What happened, in fact, was that there was only a short blip up in treasury yields, and then they went back down to where they had been before. And the flows evidence is quite similar. In the month after the end of QE2, there was no notable change to capital flows to emerging markets, which continued at a solid pace. So the flow effect seems to be relatively limited, at least when looking at a short period of time, and therefore tapering of asset purchases should have only a relatively small impact in terms of the flow effect as well. Let's now address myth number 3, which is that Fed policy rate hikes will necessarily be followed by weaker EM capital flows. The theoretical argument here is that low US policy interest rates are a push factor for capital flows that encourages greater inflows to emerging markets. While that is true, there are also other factors at play. Let's just take a look at the historical evidence first. During the last Fed tightening cycle in the mid-2000s, portfolio flows to emerging markets actually increased quite strongly throughout the Fed tightening cycle. This is directly contrary to the myth stated above. In the previous cycle, in the 1990s, portfolio flows increased first as policy rates went up, but then reversed quite sharply as the Mexican tequila crisis unfolded. So the historical evidence is not supportive and is suggesting that the picture really is more complex. And if we think about it from a theoretical standpoint, it's really important to consider the macroeconomic environment in which policy rate hikes take place. If increasing US policy rates are prompted by stronger US growth, then that stronger economic performance would tend to encourage portfolio flows to emerging markets and capital flows more generally. Stronger US growth is good because it increases import demand for emerging markets, which supports their growth. And also stronger US growth is good for financial confidence more generally. By contrast, if the increase in US policy rates is prompted by higher US inflation, then that would be a negative factor for EM capital flows. Overall, I have 3 key takeaways from this presentation. First of all, shifts in policy rate expectations seem to have a direct impact on portfolio flows to emerging markets. Second, in terms of reductions of asset purchases and how these announcements of reductions impact portfolio flows, it really matters what markets are pricing in already. And third, when the Fed will actually increase policy rates, what the impact or the overall developments for capital flows will be really depends on the broader macroeconomic environment. Thank you very much for your interest in this presentation. We encourage you to share your feedback and invite you to visit our website for videos on this and other topics in the future. Thank you.